Apple is in the midst of a huge sell-off due to Bank of America recently downgrading the stock, and this led to a huge decline within the whole technology industry over the past few days. If we jump back over to Seeking Alpha, we can see this company is down about 6.2% in the past 5 days alone. If we look at the past month, we can see they're down 12%, and year to date, they are down 21.72%. Now, this is a stock currently trading at $142.48 per share. So in this video, we're going to be jumping into my stock valuation spreadsheet to see if we can find the intrinsic value of Apple. And on this spreadsheet, we have 4 different valuation models. We have Graham's valuation, we have a discounted cash flow model, we have a multiples valuation, and a dividend discount model. And all 4 of these valuations are going to roll into our output tab. So let's go ahead and jump over to our stock screener. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. But let's go ahead and come up here, and all we're going to do is plug in the stock ticker for Apple and hit enter. And you can see all of this data is going to automatically load in. And you can see there's been a lot of volatility over the past few months with this stock. But if we come over here and look at the dividend data, we can see they're currently paying out 92 cents per share, which gives them a very low dividend yield, sitting right at 0.65%. But they also have a really nice low payout ratio at 14.6%. Now, the 20, 50, and 200-day moving averages all down by a pretty large amount. If we come down here, we can see analysts still have a pretty high target price at $182 per share. A lot of analysts are currently revising those target prices to reflect lower values, though. If we come over here, we can see they have a beta of 1.23. So yes, as you can see with the chart, they will have a little bit of volatility. But let's go ahead and jump into our first valuation model. And the first one we're going to look at is Graham's valuation. And this is a valuation model invented by Benjamin Graham, one of Warren Buffett's mentors. And here's the formula he lays out for us to calculate intrinsic value. So you can see the variables we're going to plug in here. We're going to have our earnings per share. We're then going to multiply that by 7, which is the price to earnings of a company with no growth. And then we apply our growth rate projections right here. We then multiply that by 4.4, which is the average yield of AAA corporate bonds. And once we have all of that, we divide by Y, which is the current yield on AAA corporate bonds, currently very high, sitting at 4.65. And once we plug all of this in, this comes to an intrinsic value of about $114 per share. Now, there's a couple of different things that are driving this valuation to be lower. Growth rate projections are currently lower for this company due to the market outlook, and also this current yield of AAA corporate bonds being as high as it's been over the entire year is going to drive down this valuation as well. Earlier this year, it was as low as 2.8. So if it were to jump back to that price, we can see the intrinsic value jumps up considerably, up to $190 per share. But let's go ahead and put this back. So intrinsic value of $114 per share with Graham's valuation. Now, the next valuation we're going to look at is one of the best ways to value a company, in my opinion, and that's the discounted cash flow analysis. And in order to perform this valuation, we need to project a growth rate to the future free cash flows for this company. So what we do is we plug in the historical free cash flow over the past few years, and we can see they've had pretty good free cash flow growth year over year. Overall, pretty positive. We can see they have an average growth rate of about 12.75%. So moving forward, I'm projecting a growth rate of about 13% for this company to the future free cash flows. I also use that growth rate for the terminal value, which is the sum of the future free cash flows past the year 2030. I then found the present value of these future free cash flows and added them together here. I added the company's cash and cash equivalents and subtracted out their total debt to find their equity value. Once I had the equity value, I divided by the shares outstanding to come to a discounted cash flow price per share of about $190 per share. Now, that's pretty interesting because we saw with Graham's valuation, if our current yield on AAA corporate bonds was 2.8 like it was this year, it would be sitting at 190. But let's go ahead and keep moving forward, and we'll look at our multiples valuation. And the idea behind this valuation model is we should be able to see how the market is valuing companies that are similar in structure using a multiple such as the price to earnings multiple. So you see, we're taking companies like Microsoft, Google, and Meta. We take their stock price and divide by the earnings per share to get our price to earnings multiple. We then take the average price to earnings multiple for these companies. We multiply by Apple's earnings per share and come to an intrinsic value of $146 per share. Now, the average price to earnings for these companies up here is 24.14. We jump over to our stock screener. We can see if we scroll down, Apple is very close to that level, which leads to a pretty close intrinsic value to its current trading price. Now, the last valuation model that we are going to look at is the dividend discount model. And this is a valuation model that values a company based on how much they pay out in dividends and how much that dividend is increasing over time. And if we jump back over to our stock screener, we already saw that this company does not have a very high dividend yield. So if they do have a high valuation with this valuation model, then that's going to be because they have a high level of dividend growth. But if you look right here, we can see I plugged in the quarterly dividend payouts so we can see how much they pay out each year. And this allows us to see our year over year dividend growth of about 5.5, 6.5, 7.3, 4.5. So overall, pretty decent dividend growth. That gives them an average growth rate of about 6%. Moving forward, I'm sticking with that growth rate of 6%. That's very sustainable when you look at their free cash flow and when you look at their low payout ratio. But jumping back over to our valuation model, you can see I'm applying a discount rate of 8.5%. When we plug all this in, we come to a dividend discount model price per share of just $39 per share. So obviously very low according to the dividend discount model. This company doesn't really provide most of its value through the form of dividends. So this is probably not the best way to be valuing a company. So because of that, when we jump over to the output tab, you can see I'm not using the dividend discount model in this calculation, but I am averaging these three valuations here together. We can see grams at 114, multiples at 146, and discounted cash flow at 190. When we average them together, we come to an intrinsic value of $150 per share. Now you have to keep in mind, companies like Microsoft, Apple, Amazon, Coca-Cola, these companies typically trade at a premium, so it's very rare that they trade below their intrinsic value. But we can see this is a scenario where it looks like the current price is slightly below the intrinsic value for this company. But as a value dividend investor, we do always want to apply a margin of safety. So let's say we apply a 10% margin of safety. Based upon this, we can see our acceptable buy price for the company would be $135 per share, meaning now is not a good time to buy the stock. Let's say we want to apply a 20% margin of safety. Based off of that, our acceptable buy price would be $120 per share, and it would still not quite be a stock we want to buy. Now, I can see the stock going a little bit lower. I think the market conditions currently are pretty negative. Obviously, if you look at the news, the stock could go lower, but it's not very often that this company trades this low. So this may be an opportunity if you're looking to buy into Apple. As for me, I already own a few shares. I'm not currently planning on adding more. I'd like to see a little bit more dividend growth or a higher dividend yield from this company, but I'm going to keep them on my watch list. If it goes lower, then maybe I'll reevaluate. But go ahead and let me know what you think of this company in the comments down below if you plan on buying or selling. If you'd like to be able to download the spreadsheet, you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.